Hi everyone, and welcome back. In this video, we're going to continue working through chapter 4, which focuses on adjustments for adjusted gross income or adjustments for AGI. So if you remember in the first video, we talked about the idea that these deductions happen before we calculate adjusted gross income, which is why they can be especially valuable. They reduce income early in the tax formula, and because of that, they can sometimes also affect eligibility for other deductions or other credits later on in the return. In this video, I want to focus on 3 topics that come next in the chapter, and they are moving expenses for members of the armed forces, deductions for half of self-employment tax, and the self-employed health insurance deduction. At first glance, these may seem like very different topics, and in a way they are, but what they all have in common is that they are specific deductions that only apply in certain situations. So as you work through this section of the chapter and your homework, one of the most important questions to keep asking yourself is, who qualifies for this deduction? That question is really central to this part of the chapter. So for example, if you're not a member of the armed forces or you're not self-employed, these deductions or these adjustments to AGI are not going to be relevant for you. So let's start with moving expenses. Now, historically, taxpayers could deduct certain moving expenses when they relocated for work, as long as they met various requirements. But under current law, that deduction has been dramatically limited. Today, the moving expense deduction generally only applies to members of the U.S. Armed Forces who are on active duty and move because of a permanent change of station. So right away, that tells us that this is a very narrow deduction. This is not a deduction that most taxpayers will qualify for. The phrase permanent change of station is also very important here. That generally includes situations like moving from home to the first active duty assignment, moving from one permanent duty station to another, or moving from the final duty station back home, as long as that happens within a required period of time. So this deduction is really tied to military orders and service, not just a general work-related move. Now, the slides use the phrase unreimbursed moving expenses, and that is a term students often find kind of confusing at first. So let's slow down and make sure that that's clear. Unreimbursed simply means that the taxpayer paid the cost personally and was not paid back for it. So, for example, if a service member pays to move household goods, they rent a truck, they pay for airfare, or they pay for lodging during the move, but the government does not reimburse them for those expenses, those may potentially qualify as deductible moving expenses because they're unreimbursed. But if the government pays those costs directly or reimburses the service member afterwards, then those costs are not deductible because the taxpayer ultimately did not bear the expense. They were made whole. They incurred the expense and then the government reimbursed them for it. That distinction matters a lot. A helpful way to think about it is this. If someone else paid for the expense, the taxpayer does not get a deduction for it. If the taxpayer paid for it themselves and was not reimbursed, then it may qualify. And that is the basic idea behind unreimbursed. Now, what kinds of moving expenses are we actually talking about? The chapter points to several examples. Qualified moving expenses may include the cost of transporting household goods and personal belongings, storage of those household goods for a limited period of time, travel costs associated travel costs involved in moving from the old home to the new home, mileage if the taxpayer drives a personal vehicle, and lodging during the move. One detail students often miss is that meals are not deductible. So they were not on that list. So if you're doing a problem and it describes meals as one of the expenses, those are not deductible moving expenses. In this context, travel and lodging may qualify, but the meals do not. The chapter also notes that the taxpayer can either deduct actual car expenses like gas and oil, or they can use the standard mileage rate for moving expenses, which for the year, I believe is 21 cents per mile, which is shown here in the slide. So if a service member drives their own vehicle as part of the move, that may be part of deductible expenses. The deduction also extends to moving expenses of other members of the household, not just the service member, as long as they are part of the qualifying move. Another point the slide mentions is that if reimbursements or allowances from the government are greater than the actual moving expense, that excess may need to be included in income. So in some cases, these moving related payments may not only affect deductions, but they could also affect gross income. And that's one of the reasons that this area can get a little technical. There's also a special rule for foreign moves, where the deductible moving expense can be broader, including storage for a longer period in some cases. For the purposes of this course, though, the most important thing to remember is the big picture. The deduction itself is very limited under the current law, and it generally applies only to active duty members of the armed forces that are moving because of a permanent change of station. And when it does apply, the deduction itself is limited to qualifying unreimbursed expenses. And that is really the key concept that you want to take away from this section. Now let's move into the deduction for half of self-employment tax. This is a really important concept because students often understand the rule mechanically, but don't often understand why it exists. And when you understand why it exists, it becomes much easier to remember. So when someone works as an employee, they pay Social Security and Medicare taxes through payroll withholdings. Those taxes are often called FICA taxes. The employee pays 7.65%, and on the other side of it, the employer pays another 7.65%. So together, the total Social Security and Medicare tax on wages is 15.3%. But from the employee's perspective, they only directly see half of that amount because the employer covers the other half. Now compare that to someone who's self-employed. A self-employed taxpayer does not have an employer that's paying the other half of those taxes. Instead, the self-employed individual has to pay both portions themselves. And that is why self-employment tax is 15.3% of net earnings from self-employment. So this chapter refers to this as self-employment tax, but conceptually, it's the self-employment version of Social Security and Medicare taxes. Now, let's talk about net earnings from self-employment because that phrase, that matters. That means the taxpayer does not pay self-employment tax on total revenue. Instead, they pay it on net earnings, which is basically your business revenue minus your business expenses. So if a self-employed taxpayer had $120,000 of gross business revenue, but they had $40,000 of deductible business expenses, their net earnings are only going to be $80,000. That net amount is the figure used to calculate your self-employment tax. The tax itself is calculated on Schedule SE of the 1040, which again, of course, is filed with the taxpayer's 1040. Now, here's where the adjustments for AGI come in. Because self-employed taxpayers have to pay both halves of the Social Security and Medicare taxes, they've got to cover the employee portion and the employer portion, the tax law allows them to deduct half of the self-employment tax as an adjustment for AGI. Conceptually, this deduction represents the portion that normally would have been paid by their employer if the person had been an employee instead of self-employed. That's the policy reason behind the rule. It's trying to put the self-employed taxpayers in a position that is a little more comparable to employees. So let's just look at a quick example because I think this helps the concept click. Suppose a self-employed taxpayer calculates their self-employment tax for the year and it's $12,000. Now they still have to pay the full $12,000. The deduction does not reduce the tax itself dollar for dollar, but instead it allows them to deduct half of that amount, which in this case would be the $6,000, as an adjustment to their income. So the deduction reduces the AGI, but it doesn't eliminate the self-employment tax. Now, students sometimes confuse those two things. They hear deduction for half of self-employment tax and think maybe the taxpayer only has to pay half the tax. And that's not what this rule means. The taxpayer pays the full self-employment tax and then they receive an income deduction equal to half of it. And that distinction is very important. Another way to say it is the taxpayer pays the full self-employment tax, but they get to deduct half of it when calculating AGI. And this is really the core rule here. Now let's move to the third topic in this video, the self-employed health insurance deduction. This is another adjustment that applies to self-employed taxpayers, and like the previous one, it exists partly because self-employed individuals do not always receive the same employer-sponsored benefits that employees do. Many employees receive health insurance through an employer. Sometimes the employer pays part of the premium and the employee pays the rest through a payroll deduction. Self-employed taxpayers, on the other hand, often have to purchase health insurance on their own. And because of that, the tax law allows qualifying self-employed individuals to deduct 100% of the health insurance premiums they pay for themselves, their spouses, and their dependents. This deduction is taken as an adjustment to AGI, which means, again, that it can reduce income even if the taxpayer takes the standard deduction. However, there are two important limitations here. The first limitation is that the deduction cannot exceed the taxpayer's net earnings from the business under which the insurance coverage is provided. So the deduction itself, it can't put them in a loss position. So if the taxpayer has little or no self-employment income, the deduction may be reduced or it's just going to be unavailable to them. The second limitation is that the deduction is not allowed if the taxpayer is eligible to participate in any subsidized health plan maintained by an employer, either their own employer or the employer of their spouse. And the last part, it's especially important. So even if the taxpayer does not actually enroll in the employer-sponsored coverage, the key issue is eligibility. If they were eligible to participate in that plan, then the self-employed health insurance deduction is not allowed for those months. And the chapter notes that eligibility is determined on a monthly basis. So if the taxpayer was eligible for employer-provided coverage only part of the year, that can affect how much of the deduction is allowed. And this is another area where students sometimes oversimplify the rule. They think I'm self-employed, so I deduct my health insurance. But the real rule is more specific. The taxpayer must have had qualifying self-employment income, and they must not be eligible for other employee subsidized coverage for the months in question. And that's what determines whether the deduction itself is allowed. So in this video, we covered the 3 adjustments for AGI that apply in specific situations. As you work through the chapter materials and the homework, try to focus on the same core questions we mentioned at the start. Who qualifies for it? What is the limitation? And where does it fit in the tax formula? As always, if you have questions, reach out. Otherwise, I'll see you in the next video. Thank you.